All right, let's go ahead and get started. Today is Monday, February 12th, 2 p.m. section. This is being recorded for YouTube. So a few things today. First, I want to check in on the Bloomberg Trading Challenge. And while I am doing that, there we go. This is section 301. This is where you stand on portfolio value as of today. Again, I don't count anyways in the last place. Team actually in first place made almost 9% in a week. That's pretty impressive. But all the teams have made some money, and everybody's below 300,000, which is good. And so again, by the end of the first half of the semester, you need 10 longs. Everybody's gone at least 9, which means at least one more trade in the next 4 weeks. But generally, this is kind of where we stand as of today. And while you're looking at that list, I'm going to pass out the attendance sheet, so make sure you sign this before you leave today. Yeah.
For like the $300,000, like, or
yeah.
Let's say for like momentarily we drop out of it, are we immediately disqualified, or is it just?
Well, you shouldn't. I'll warn you, because last class we actually had one person that was over the threshold. I gave them their warning today.
Okay.
But generally, if you sell something, you can immediately buy something with those funds. So you really shouldn't just sell it, keep it in cash.
Well, yeah.
You should trade it into something else, and you won't go over 300,000. It doesn't have like a clearing period for the cash once you make the trade. So once you sell it, the cash is immediately available to buy something else.
And so if we just use that cash immediately?
Yeah, just buy something else. Exactly. All right. Any other questions about the Bloomberg Trading Challenge? All right. So today, I extended the deadline for the Bloomberg certification. Just make sure you turn that in by tonight. If you need more than one screenshot, because it all doesn't fit on one page, turn in multiple screenshots. If you took it again for another section, multiple screenshots. But regardless, your certification's due by end of day today. Any questions about BMC? All right. Wednesday is the first group project, which is called Group Case EIC. Okay, this is 10% of your semester grade, and again, you're going to do a 10-minute presentation in PowerPoint for the EIC on Netflix and its industry. All right, for purposes of Wednesday, you're all presenting essentially the same data. Okay, in later group cases, I'll give you an industry. You'll all pick individual companies to present. But for the first one, you're going to all present it on Netflix and its industry. Okay, it's an EIC in PowerPoint. Same screenshots, they have to be in the PowerPoint, okay? And you'll have 10 minutes to cover everything. It's very important you cover everything in those 10 minutes. I'll be sitting kind of right there in the middle, listening to your presentations with my iPhone and a 10-minute countdown timer. When it hits 0, you're done. And if you don't cover, you run out of time, something, I'm not going to give you credit for it. Okay. Also, if you're missing data that's not in the PowerPoint, I'm not going to give you credit for it even if you talk about it. So make sure everything that you need is in that PowerPoint, and that PowerPoint is loaded and submitted by one of your team members by 10 a.m. Wednesday morning. Okay? Because if they don't submit a PowerPoint on behalf of your team, you're going to lose a lot of points. Okay? So make sure that's all in by 10 a.m. and that's the presentation you're going to give on Wednesday. Yes, sir. I'm sorry? It can be Google Slides. That's fine. But make sure you submit a PDF from the Google Slides for your submission, just so I have a copy of it, because I'm going to load what you submit to have it on my laptop while you're actually making your presentations. Okay? So back to the grade. This is 10% of your semester grade. Again, it's on the EIC. Make sure you cover all of the EIC. All right? In terms of the presentation, you're going to get a group grade for this group presentation. All right. So I'll let you decide who's going to present on behalf of your team. Most of your teams have 8 people. I wouldn't recommend all 8 trying to present. Like, you'll just 10 minutes too inefficient. So you're probably going to have 1 to 3 people realistically present this presentation. Up to you. You'll split it up however you want. Yes, sir. Well, I was about to get to. No, I don't care if you use note cards. So What I do care about is that over the 4 presentations you do this semester, everybody will eventually have to present. Okay, so if you don't present this one, you might present in a later one, but you got to eventually present. But it's up to the team who presents, and you're going to get a group grade for that presentation. Now, the presentation itself, I'm not going to grade you on how you're dressed up. Right? Like as I was walking in this morning, I saw this woman, woman who's walking into the building in basically slippers and pajamas. Okay. Now, I don't think that that's really appropriate for going to class, but you know, I'm just old, and maybe that's what you guys just do. But whether you're just rolled out of bed or got out of the gym, that's not what I'm going to grade you on Wednesday. So you want to look like a slob, fine. Okay. For this class, I'm not going to worry about that. What I am going to grade you on is what you say. Okay. And if you say it wrong, or you don't say it, or you don't use numbers to say it, that's where you're going to get credit hurt. So back to note cards. If you want to use note cards to make sure that you get it right and you say everything, perfectly fine. All right, I'm not going to take off for style points because you're reading note cards. It's more important to me that you say the right things and understand the content than exactly presentation style and how you're doing it. Okay, but nonetheless, I mean, if I can't understand what you're saying, you're unintelligible. It's not going to help your grade either. Right, but nonetheless, that's the presentation. Okay. The other thing I'll mention about the presentation is 10 minutes means 10 minutes, and you got to cover everything in 10 minutes. Okay. So where I have seen teams go awry in the past is usually one of 2 bad things happens to you. Number 1, timing. Okay. So basically what you'll do is you'll split the presentation up. Everybody does their section. You'll smash it together as one file, and then the very first time it's presented is in class. And I'm just telling you, I riff all the time, and I'm okay at riffing. You're not going to be good at riffing, and you're going to screw up your timing. And so what will end up happening is the team, because EIC, the 5 forces usually takes the longest. So the 5 forces people go like 7-8 minutes, and they run out of time after the E section, and there's just no time for competitive advantage. Well, your team just lost 3 points out of 10. Okay, and there's nothing I can do about that. So my recommendation: practice. All right, don't make being in front of the class the very first time you practice that presentation. The other things where they go awry is the inconsistencies and contradictory stuff through the sections. Again, because you usually split up the presentation, somebody in the E section will talk about this is the greatest industry since sliced bread, and somebody in the I section says this industry sucks. All right, and I know you're chuckling at that. I will too, as I drop off lots of points because you're contradicting yourselves within your own presentation. So be consistent across all the sections that you talk about. That's not just for this paper, or this presentation, it's for all of them, and your papers as well. But more importantly, make sure you mind your time, okay? Because that's where you're going to actually lose points on the grade, because I'm going to grade the whole thing, okay? Also, because for this one, you're going to be repeating what other people said. Like you're the 13 to present, your answer shouldn't be ditto for this section. Like if you don't say it, I'm not giving you credit for it. So I don't care if you're repeating what other people do. I expect some repetition, okay? Because I'm grading you on what you say. I'm not grading you on what other people said, okay? We're not building across the presentations. You all have to cover the material during your 10 minutes, right? When we get to 10 minutes, I will politely ask you to wrap up. I'll give you 15 to 30 seconds, and then you have to be done because we have to get through all 6 teams, times 10 minutes a team, that's an hour, plus travel time between teams. That's all we're going to do on Wednesday's class, okay? Which also means I'm not going to have time for Q&A. So I'm likely not to ask you a question. If I ask you a question, it's bad for your team, okay? Because it means I'm confused about something, right? So I'm not just going to ask questions because I think it's important to do. We just don't have time. So questions from me are bad, all right? So usually at the end of your presentation, thank you, team 1. Who wants to go next? And I will take volunteers. If no volunteers, team 2, you're up, okay? That should be all you're going to hear from me, all right? Final point, and this is really important. This is true not only for this presentation, but this is true for all presentations. And I'm putting this on video so that there is no ambiguity, okay? You will be respectful of the teams presenting during the time they're presenting. They're nervous. This is 10% of the semester grade. You're not going to do anything to disrupt that, which means for that class, you are not allowed to be on your phones. You are not allowed to be on your laptops. You're not allowed to be on your computers. You're not allowed to talk to each other during the presentation, okay? There should just be nothing but you sitting there respectfully listening to the people who present, all right? So phones on silent, put away, computers down. If there's an emergency, leave the room, okay? But do not disrupt the teams. If you are disruptive of the teams, and I find that, I will ask you to leave the room, and I will give your team a 0 for the presentation, the entire team for your disruption. This is your one and only warning. This cone of silence goes down 4 times this semester, 4 presentations. Today, I don't care. You don't want to listen to me. You want to be on your laptops. You want to be playing Fortnite rather than sitting here in class. It's up to you. It's your tuition. I can handle it. But when teams are presenting, we will be respectful of them, okay? Including they will be respectful of you, and that is required, right? And if you can't do that, don't come to class, right? And by the way, unexcused absences lose 5% of your semester grade on Wednesday, okay? So if I escort you out, your whole team is going to be taken down with you. And then you're going to deal with the consequences where your team hates you for the rest of the semester. So just don't do it. It's not worth it. Any ambiguity about what I'm asking? Okay. All right. Finally, on Friday, you're going to do a peer review. Okay. So you get a group grade for each group presentation, including Wednesdays. So let's say you get 9 out of 10. Okay, and I'll explain why I took off a point, right, when I give you the grade. Let's say you get 9 out of 10. The whole team gets 9 out of 10. Okay? But that assumes that everybody put equal participation in putting in that grade. If you didn't help participate in the presentation, you shouldn't get a 9. Okay? So what's going to happen is on Friday, you're going to submit a spreadsheet with every team member's name on it with a percentage from 0 to 100. Okay? If they fully participated, 100%. If they never showed up and you don't know who they are, 0%. Okay? And then percentage in between. Right? If one of your team members, and by the way, you also have to score yourself. Okay, so you have a spreadsheet, every name of your team members, including yourself, and then the percentage is 0 to 100, right? Hopefully, everybody's just 100% across all the team members. Easy peasy. Everybody did the equal amount of work. That's what I hope has happened. But if one of your team members scores you less than 100%, I will not change your grade. If 2 or more of your team members say less than 100%, I will adjust your grade. So let's say on your team, one team member said 0, and another team member said 50%. And everybody else said 100, okay? Given those 2 team members, I clearly assume if somebody said 50%, you must have done something. So what I'm going to do is I'm going to take 50 and 0 and average them to 25, and I'm going to take 9 times 0.25, and that will be your grade individually, okay? So this is your ability, because I'm not there, when you guys work on these team projects, to represent whether people worked on the projects. You will do these peer reviews, not only for this EIC assignment, you'll do it for the Bluebird Training Challenge and every other group project, okay? Because again, you had to participate in the group projects to get a group grade. Any questions about the peer reviews? Those will be due Friday. You'll submit that spreadsheet, upload through ELMS, and that's the other point, which is save that spreadsheet, because you're going to use that spreadsheet for the other projects. Just going to add another column for each one of the projects and resubmit that file. Those are the peer reviews due Friday. So any questions about the EIC case or the peer reviews? All right, so final thing, we're going to talk about homework 3 in just a second, but I noticed that homeworks 4 and 5 are due on Monday, okay? The content for homework 4, we haven't got time to cover this week because we're going to do presentations on Wednesday, so I'm going to move out homework 4 to next Wednesday. And the content for homework 4, we're going to talk about in class on Monday, okay? But I'll warn you, this is the most difficult part of the class, okay? Because it involves rearranging statements, and it's kind of like learning a new language, okay? So if you have the book, this is the reading for the book, I'd recommend reading it on converting financial statements, but nonetheless, that's what we're going to start getting into next section of the class starting on Monday. But homework 5 is still due on Monday, and later in this class, we'll talk about how to do homework 5, okay? All right, but before we do that, let's talk about homework 3, which is your assignment on CBRE. So for the assignment on CBRE, homework 3, EIC. So the first thing you'd have done is you've gone to CBRE, RV, markets beta, and you'd have had a screenshot that looks something like this. Depending on the week, you could have had a beta, industry beta of 1.32, 1.31 I've seen the last week, somewhere around that. And for CBRE, you should see their beta at 1.19. So is the E part of this is the easy part. You should say something along the lines of this industry is more economically sensitive because the industry beta is 1.32. Although CBRE, which is economically sensitive, is not as economically sensitive as the average company in the industry because their beta is only 1.19. Okay? Now, if you do that on Wednesday, and that's all you do, and you then move to the I section, I'll put -1 towards your grade. Okay? Because that's not enough. That's required, but that's not enough. Okay? See the screenshot, you got to start saying the data. But then you have to explain why. Why is this industry have a beta of 1.32? What makes it more volatile? There has to be some explanation for that. Okay? So make sure you answer that question as well. So in the context of your homework assignment, why a 1.32 beta? What makes this industry a little bit more economically sensitive? What'd you say? Yeah.
I talked about interest rates and how that had a big impact on like the commercial real estate industry because when interest rates are high, people are not really going to want to purchase any real estate. And then on the other hand, when interest rates are lower, it makes housing more affordable, and so there's going to be high demand for real estate in general.
Yeah, and I think that applies to both commercial and residential. And I think that's a good reason for some of that economic volatility. So if you had added that answer, that would have been a great answer. And I think that's exactly what we're looking for. That's not the only thing you could have said. You could have said some other things in the E section. Does anybody say anything else besides the interest rate volatility? Yeah.
Talk about vacancies when the economy's pretty bad, especially with like business, retail space.
Yeah. And then the other part is the retail space, is what he just said, just for the purpose of the video. So that basically in bad times, less retail, less need for retail space shutting down, good times, more retail space. So you could have talked about that. You could have talked about how this industry is more commercial than residential in terms of what these companies are doing, and that's even more volatile than the residential real estate market, right? But you had to say something to explain the 1.32. Then the second part of this is CBRE is only 1.19. Why are they a little less volatile than the industry? So what makes them have a lower beta than the rest of the industry? What did you say for that? Or what would we say for that? Yeah.
They're exposed into a variety of industry segments. They're responsible for commercial real estate lending, commercial real estate consulting, commercial real estate leasing, rentals, so on and so forth. So it's more than just selling or leasing out pieces of commercial real estate. They're kind of
So they as the big player are more diversified than most of the players, and that diversification tends to lower their beta. It's basically what you're saying. So they kind of have an economy of scope. Okay, so I think it's a really good answer that helps explain why CBRE is a little less volatile because of that diversification. Okay, you could have also said just their size, meaning economy of scale. CBRE deals with big global companies just because they're bigger and they have more space across markets. Well, that means they can do bigger contracts for longer terms for a lot more space, and that tends to reduce some of their volatility as well. Okay. So there's several reasons that you could give, but you got to explain what you see. And that's going to be true for all of your projects, including your group case that you're presenting on Wednesday on Netflix and the industry. All right. Once you do this, you'd have then moved on to the I section. And by the way, you're probably going to get that done in 90 seconds, 2 minutes. Okay, still got 8 minutes to go to cover everything else because time's go by fast. So then you're going to go to custom, and you're going to go to the spread. And so the first thing you're going to do is you're going to have up this screenshot in your PowerPoint as well. And then you're going to talk about the industry. And so this industry has an ROIC last year of about 4.22% against a WACC of 8.83%, therefore a negative spread, value destruction in the industry today. It's not an attractive industry today. And then you move into the 5 forces today, why this negative spread? So the whole point is you got to explain what you observe, with the negative spread in the context of the 5 forces. So buyer power, supplier power, substitutes, barrier to entry and exit, rivalry, what of those is leading to this negative spread? What'd you guys say? Which of those forces are unfavorable to this industry? Yes.
Substitutes.
All right, in what way?
So I keyed in on like the commercial real estate, like hybrid and like online workplace is becoming increasingly more common after the pandemic. So I was saying like with the increase of these substitutes in the past few years, it really is not good for.
Yeah. So I think a really good point. And again, you could have put it in a different bucket, but argue for substitutes makes sense. But the idea is that all this work from home, all this hybrid work has been bad, particularly for the commercial real estate market. And that has put pressure on the profitability of this industry. Okay? Because I'm leasing out commercial space and people aren't using as much commercial space, then that's putting pressure on why these are now distressed properties. Okay? And the other thing is, if we had done this analysis in 2019, we would have had a different answer. Like if you asked the 2019 version of yourself, like, do you think the commercial real estate market's gonna be hurt by people working from home? Like, yeah, maybe like a gnat on an elephant, but it wasn't serious to the industry and nobody thought it was gonna happen. Post-pandemic, the world's a different place. And so now the question is gonna be, are people returning to the office? Because we have done work from home, but nonetheless, that's probably really affected this industry in terms of the results today. In fact, it's affected on the retail side if you think about online retail. Like if we're not going to stores, you don't need as many stores if we're ordering everything online, and that's affecting basically the retail side of the stores, okay, which these people are also managing the malls and other businesses themselves. So that is somewhat offsetting this. But the point of this story is that substitutes are working against this industry, which is explaining part of the negative spread. What other forces matter? Battery's about to run out, so we can plug this in before it does. What other forces? Yeah.
I just talked about how like with high buyer power, people can choose whether they want to enter into like leases or mortgages depending on like what the interest rates are. So if the interests are high, people will not be entering those kind of agreements.
Okay. So the buyers you're saying have a lot of power right now.
Yeah.
Okay, makes sense. Go ahead.
Supplier power, because there's a lot, it's very limited, like prime commercial real estate spots.
So who are you calling the suppliers to this industry?
Like kind of the buildings,
Who?
buildings.
So the people that are actually the construction companies?
I was thinking more so like the actual buildings themselves, like if they wanted to acquire new ones.
Okay, so just the traditional inventory of the buildings. Okay. And so you're saying that the suppliers don't have a lot of power over this industry? They do or don't? And that's actually hurting the industry profitability. Okay. Matter of fact, the other side of it is on the retail side. Like, I have a 3% mortgage on my house, right? There's no chance I'm selling my house anytime soon. Like, why would I want to buy a similar house with a mortgage at 6.5% or 7% and essentially pay 50% more for the same house? So there's just a lot of people, in particular the residential real estate side, that are just sitting on the sidelines that don't want to participate in the marketplace. And so it kind of reduces the inventory. Ironically, you would think that that would actually make the market better, right? Because there's fewer houses available and therefore prices are high, which it has during the pandemic. But now we're starting to see the other effects, which is as interest rates start to come down and more supply shows up in the marketplace, then prices are actually starting to fall. Okay? And so we saw prices falling on the commercial side. We're now seeing prices start to fall on the retail side. Kind of good for affordability, but it's actually not really good if you're trying to lease out stuff at lower rates and make less money. What else? Rivalry. Is rivalry in this industry pretty strong or not? I see some nodding heads. Why is it strong?
I think like the top 4 players occupy like 2% of the entire industry revenue.
Yeah, and so you got a lot of small players in a lot of individual markets. They're all fighting to lease space, and there's a glut of space, and so it's just made the market very, very competitive. Okay, so again, you have to talk about eventually all 5 forces. Right? These are really good explanations, but you got to explain the spread you see. And now, for the $1 million question, is anything that's going to change in 5 years, right? Because what you're really doing in the 5 year, 5 forces is you're kind of predicting what the spread is. So if any of these forces get more favorable, then you're predicting that the spread's going to go up. If the forces stay about the same, the spread's about the same. If forces get worse, the spread's going to get even more miserable. So what's your 5 year crystal ball say? 5 year, 5 forces. Yeah.
Mine ultimately kind of depended on whether or not companies like CBRE are able to diversify what they do. Because if these companies kind of stick to the market right now, it's just going to be around the same, because nothing within the commercial market is going to change relatively soon. But if there are companies that are able to diversify more, then the spread might become a little bit more favorable. It'll still probably be negative, but it'll be a little bit better.
So what was your prediction in your paper?
I wrote.
Did you predict that it was going to get more diversified and more favorable?
Yeah, no. So I wrote about both
Scenarios.
So one option was nothing changed and the spread would likely remain the same. The prediction, if they do diversify, is that I think both ROIC and WACC will both increase, but the spread will come down a little bit. It'll be like.
But again, which forces will change that? What's your call? I appreciate the optionality, but do you have a call for which one you think is more likely?
I mean, it's. I would hope it's like the diversify one, simply for their sake.
Yeah, so you think it's going to be diversified more. So that's the point. I like the optionality. It's actually a really good answer. But the point is pick a point of view when you actually make your presentation. I think it's going to be these choices, but this is the one I think it's going to end up being. So I'll give you a good example of diversification. ESG is becoming big in the building industry, right? Probably more so than in automobiles, because having a sustainable building, they can prove lowers cost. Right? Because if I can show you that my sustainable building uses less electricity, then you save money on your building. If I can show you that my sustainable materials will last longer and need less maintenance, that will actually save you money over 20 years as a building owner, and that's a real NPV savings. So in this business in particular, there is a drive towards sustainability. CBRE and JLL, which is Jones Lang LaSalle, are kind of leading this effort on a scale basis, and that's actually changing the way that they lease. And the bigger companies care about this, not because they care about the environment, but they know it leads to real dollars and cents in these buildings the way that they're managed. And that is diversification that will allow them to make money on these types of services beyond what they just lease a Class A office space. So absolutely. What else about 5 years from now? Yeah.
I said that I thought substitutes would continue to increase, so more people working from home as work cultures kind of change.
Okay.
More hybrid work cultures allowing for less need of an office building.
So what does that mean to this? Which power changes, and what does that mean to the industry?
So I said that substitutes would go up, which kind of in turns affects rivalry in the industry, as some of those small players then can, if they have to step out and afford to stay in.
So you're actually saying the industry is going to be worse in 5 years?
Yeah.
Okay, and so that's a legitimate point, which, by the way, can be different than his point, and that's okay. Because when we're talking about the future, can't say either one of you are right or wrong, but what I liked about both of your answers, which is more important the way I'm grading you in this class, is you're giving a point of view based on data. And you're connecting some dots. I think the substitutes are getting worse, which will put pressure on the spread, which will lead to a lower performance for these reasons. I think that the substitutes and rivalry will get better because of the diversification, which for these reasons will get better. Those are both good answers, and that's what I'm pushing you towards. All right, so that's the point. I don't want you to solve a formula. I want you to use a data point. I want you to use your minds and real data to kind of play out these scenarios. That's what's important. So you can disagree and have perfect answers in this class, okay? But you got to have an answer that makes sense and follows the process. That's what we're going to continue to practice, not only for this assignment, but all assignments. Anything else going to change in 5 years? Either way? Yeah.
I thought revenue entrance would increase because we're talking about how they're like vertically integrating through like property management and construction. I thought it would become more difficult for like newcomers to kind of acquire that knowledge to do so.
So the barriers are going to go up too? Is that help or hurting the industry?
Or helping the industry.
Should help the industry. Matter of fact, go ahead.
I was gonna say, with increased rivalry, I thought buyer power was gonna increase because you have more players in the game and they have to be able to, I guess, provide better services to the buyers. So therefore, the buyers would be able to get, I guess, lower prices and higher quality.
Okay. So that could play out. By the way, this one, the rivalry could go either way. Somebody made a comment a minute ago that these companies represent 2% of the market. A lot of small players are going to really struggle with these conditions, which means there's probably going to be consolidation and shakeout. And so if you actually see a bunch of small players go away, this industry could become more profitable because there is less competition and the bigger players benefit from that. So you could also make that argument as well. So there's several ways that we could play this, but these are some of the factors that we should be talking about as we think what could happen in 5 years. Okay? Questions about the I. For C, competitive advantage, CBRE demonstrates competitive advantage. Even though their spread is negative, 5.38 against 8.86, it is less negative than the industry of 4.22 versus 8.83. Okay, so that demonstrates competitive advantage because they are losing less. All right, so you need a reason why. Right, and to some degree we've touched upon this. One of their reasons why is their economy of scale. They're bigger, and that helps them. Their other competitive advantage is their economy of scope. They are more diversified into other services that some of the smaller players are not, and that actually gives them an advantage because they can make money in these other services that other people cannot. Okay, and they can also activate on a national and global scale where other smaller players cannot. And so that gives them a market opportunity that if you're dealing with, pick a company, Google or Amazon, Amazon's opening up data centers across the country, then I'd rather deal with an Amazon with one company that can deal with all my data centers versus I got to deal with one in San Francisco. I got to deal with one in Austin, Texas. I got to deal with one in New York City. I got to deal with yet another company in Washington, D.C. Like, it's just easier to deal with one company that deals with it all versus little companies negotiating individually everywhere. So that can give them slight competitive advantage, which is probably why they're doing a little less bad than some of their peers. Okay? But again, you have to have a reason for that. Same with your Netflix and that industry assignment. Questions about any of this? You guys good with your EICs? Understand what you're doing? Any clarifications needed? All right, then I look forward to learning a lot about Netflix and the industry on Wednesday. Okay, so educate me on that like you've educated me today on CBRE. Okay, 10 minutes, cover all the bases, make sure you cover it all, make sure your screenshots are in there, use numbers, and make sure you provide the context for those numbers walking through. All right, so moving on, I want to talk about homework 5. Okay, so you need to do homework 5 between now and Monday. What is homework 5? It gets into the second section of the class where we are going to rearrange statements and look historically. Okay? And it's going to introduce the concept of operating ROIC, which is different than Bloomberg's traditional ROIC that we've been using in the class today. Okay? So here's the deal, and it's a forward to valuation. You're worth the sum of your future cash flows. As we said last week, ROIC is a proxy for cash flow, proxy for your free cash flow. That's why we use it. Okay? So if I know your ROIC is in the future, I know the value of the firm in the future, okay, plus the growth rate. So here is an example. And I'll use Apple as a working example because it's a company you're probably familiar with. So here's Apple, right? And here is our spread template today. Which shows that last year, Apple had an ROIC of, I believe it was around 58% if I do it by memory, but last year their ROIC was, drum roll please, 57.78%, 58%, okay? So here's the idea. If I'm forecasting Apple's valuation, I take 58% and I just forwarded that out. You make 58 cents per dollar every year going forward. And it's how fast do you grow it. Okay, and there's the valuation of Apple, right? And if I did that, I would undervalue Apple. I would actually get the valuation right, okay? And here's why. Because that's an average ROIC, okay? Apple is actually two businesses. And every business is two businesses. It's an operating business which sells the products and services that occur on a recurring basis. In Apple's case, they're selling iPhones, okay? They're now selling these new goggles, wherever the heck they're called, right? They're selling iPads, all right? They're selling iTunes, right? But basically, all of that is the operating, what I do on a recurring basis. Apple's also a non-operating business, which means it owns some things that have nothing to do with sales. And one of the things that Apple has that has nothing to do with future sales is, as of the last fiscal year, they had $162 billion of cash on hand. Okay? That's called non-operating. Has value, but has nothing to do with sales. All right? Here's the problem with valuing Apple. If we assume that Apple makes 58% in the future, that means to sell more iPhones in the future, they have to borrow another $162 billion worth of cash. That doesn't make any sense. They don't have to borrow $162 billion of cash to sell more iPhones. So that's the point. Apple has a business that has about $160 billion worth of cash, making 3 or 4%. And then Apple has a business selling its products and services that makes more than 58%. And when you average the two together, you get 58%. Now, if we're going to value a company, we don't want to forecast the average because those averages are not going to grow at the same rate. We want to forecast the operating performance and we want to forecast the non-operating performance. If I just look at the operating ROIC, what do they make selling their products and services? RV, custom, spread. This is the template that we have. Operating ROIC is a formula that Bloomberg does not have, but it's a custom formula you're going to put into Bloomberg for your next homework assignment. The average ROIC, which is the traditional one, 58%, add column, operating ROIC. Last year for Apple, 604%. That means for every dollar of investment, Apple makes $6 worth of cash profit. Versus for every dollar of investment, Apple makes 58 cents of cash profit. So that's the point. They keep selling more stuff, their share prices are going to go up even faster. This is something that people misunderstand. And you're going to clearly understand when we value companies. This is what the next section of the class is about, because we have to take financial statements, which blend it all together, and separate it out. Okay? It's like learning a new language, and you're going to hate learning that new language. But I told you this is going to be the hardest part of the class, starting next week. Okay? And to get in that direction, we're going to need operating ROIC, which you don't have in your Bloomberg account. Okay? Now, just to give you a sense of, like, where's this data coming from? Okay? If you go to FA, which is historical statements, okay, IS is their historical income statement. Last year, operating income / EBIT was about $114 billion. Okay? Given they pay about a 15-16% tax rate, then that means that their no plat is about $100 billion, rounding off. Okay? So that's the numerator in ROIC. Okay? But the traditional definition of ROIC that you're taught, that Bloomberg uses, is it's the return on all the debt and the equity of the business. Okay? Which means it's on all the assets. Okay? But not all those assets are operating. So this is the difference. Okay? So if we just look at the return on the debt and equity, which is all the assets, it's 58%. Right? But if I look at just the operating assets, the stuff that actually makes their products, proxy, go to the balance sheet, that's the accounts receivable. Just keep it simple. Accounts receivable of $30 billion last year. That's the inventory of about $6 billion, $36 billion of receivables inventory. And if I'm trying to calculate working capital, I subtract out the current liabilities, which the current liabilities are accounts payable, $63 billion. So that's the point. if I were to take 36 and subtract 63, okay, they have negative, what's that, negative 27 billion of working capital, right? Because what Tim Cook figured out how to do in Apple is China pays for all their investment. Meaning this iPhone that I bought for $1,500, $1,500, was made by a Chinese company, which Apple pays about $450 for. Okay, they make the difference. They buy it for $450 from the Chinese. They sell it to you for $1,500. They pocket all the difference. Huge margins. The Chinese company called Foxconn, right, has a few 100,000 people, all the inventory, all the manufacturing facilities, all the investment. Apple's none of that. They just pay for the finished products. Okay, they're taking all the investment. Apple's taking all the benefit. Okay. But here's the point. So that's the point. That's the $60 billion. Most of that is involved in Foxconn. The reason they only have $6 billion of inventory for $300 billion in sales is because they don't actually buy the phone until Foxconn ships it to the US. So all the holding of the inventory and the raw materials, that's on Foxconn. It's not on Apple. They're making all those investments. So they have a few things in their stores and a few things in transit, and that's it. In fact, when they launched the iPhone, you ever noticed why they launch it 1 week and it's not shipped out for another week or two? Because once you put your orders in, they start shipping it out from China. And until they ship it out from China, they don't buy into the inventory. So, and by the way, if they don't sell it, the people that eat the inventory is not Apple because they don't buy it. It's Foxconn that has to eat all the unsold inventory. So they actually mitigate their downside risks, right? This is all, by the way, why the trade war between the US and China, really bad for Apple, okay? Because they are very much relying on each other for these products. But that's a separate conversation. Let's go back to this. So here's the point. I'm at, what did I call it? Negative 26 billion working capital, give or take. All right, I then have property, plant, equipment. Apple's building lands and stores around the world. $54 billion. Negative 26 and 54. Basically, Apple's got about 18 billion of investment. What's 100 billion of profit divided by 18 billion of investment? That's a 500% ROIC. That's their operating ROIC, which is 600%, because I've oversimplified the balance sheet. There's a few more items on here that we need to actually deal with. But just swagging it, I can show you why they're not making 58%. They're making a whole lot more when they sell their products, because it's all that rest of the stuff that has nothing to do with sales that is dragging it down. So Apple's got two businesses. It's got a business making 500-600% every time they sell products. It's got a business making like 4% when they put the cash in the bank. Is that conceptual? High level make sense? Yes.
Why are we calculating the spread using the total ROIC? Just simplify the process?
Why are we what?
Why were we calculating the spread previously just with the total ROIC?
We're simplifying the process, which is what most people do because they're not thinking about operating and non-operating. This is part of what this class is going to think differently about, is we're going to be a little bit more specific and granular, McKinsey's approach, to basically look at the two separately because we're going to forecast them separately. What most people are taught to do in the real world is they forecast the average. And they're not even told that it's an average. That's one of the things you're going to learn today. You're going to learn this week coming up that this really is an average. And most people don't even think about it that way. So this is a much more advanced way to do this. Okay? Yes?
Operating ROIC, the latest filing?
So that's what we're about to do. So what I want you to do is in homework 5, you were going to create a custom formula for operating ROIC. Okay? So this is where Bloomberg comes in. There are two places in Bloomberg, you know from your certification, that you can create custom formulas. One of them is in the RV screen. Okay? So you're going to go back to the RV screen. And when you go to RV, and you can do it in custom, easy enough to do, but wherever you are in RV, you're going to click on this little gear icon, and where it says Add Formula, this is where you build a custom formula. This custom formula will be unique to your individual account. So Bloomberg has its formulas, and you can put your own formulas in there with it. So you're going to add a formula. It's going to bring you a screen that looks like this. Okay? And the first formula you need is no pad or no plat. Okay, it's over here. Okay, so we need this version of no plat, which doesn't exist in Bloomberg. EBIT times 1 minus the tax rate. Okay, so here's what we're going to do. We're going to start building it here. So we need to know latest fiscal year operating income or loss. Okay, so over here, where it says function, we're going to start typing in operating income or loss, a Bloomberg field, and we're going to select it. And the one we want is the latest year for this assignment, not the latest filing. Okay, and then we're going to hit enter. And when we do, in that big box in the middle here, it's going to basically put in the database field for that friendly name. So latest operating income or losses is IS_Oper_Inc. All right. So if you're a STEM geek and you know this stuff, you could actually do it all based on that formula. Just put in the actual databases, but you got to know the Bloomberg database. If you don't know, you put the friendly name in, search for it, hit enter, and it'll put it in. And that's the other thing. When I said latest year, in US dollars equals Y latest year. If I wanted last year, Y minus 1, right? But that's the point. Choose my period. And I just pull in the database in real time for any company and basically get that data. Okay? Now, following order of operations, I need a left paren, and then I need to keep going. So I'm going to do left paren. It's down here. Times left paren 1 minus the effective tax rate. So put another left paren. And up here, I'll start typing in effective tax rate. Again, for the latest year. Hit enter. And that's going to add the database field for that. All right. And then if I'm following, divided by 100. And the reason why you're dividing it by 100 is because Bloomberg is going to store a 20% tax rate as 20. And I want it to be 0.2. That's why I'm telling you to do the divide by 100. And then you're going to do right paren, closing out the parentheses. And then when you're done, you're going to hit enter. And if you made any mistakes, it's going to tell you that you made a mistake. And I think, just make sure I got this. Close. I need one more parentheses. Trying to decide where I need my parentheses. All right, that one, that one, that one, that one, that one, not closed. So I think I need one here. No, not there. I got to get rid of the one on the left, or I need one on the left? I need to close the one on the left. So here, try that. Oh. Okay, there it is. So make sure you actually follow the order of operations correctly and put it in here. So what it's going to show you is it's calculated this for some random companies, and those are the data that is calculated for the random companies for their notepad. Okay? So then you're going to save this, and you're going to save it or save and use an RV. If you hit save, you're going to name it no plat or no pat. Okay? And then once you save it, it's going to put it into your custom formula library. Now, it's not going to actually do that for me because I've created this custom formula in a previous class. Yes? Just save it. Now, if you save and use it, it's going to stick it into the RV screen directly, okay? But here's the point. When you save it, it's going to show up in your own personal formula library. So this was the NOPAT formula that I created in the earlier class that is saved in my library, okay? So here's the point. If I go back to RV, and let's say I go to custom, I called it NOPAT because I already had a NOPAT. Custom, and I add a column that says NOPAT, which is what I called it earlier. There's my custom formula. And now when I hit NOPAT for Apple, there would be the NOPAT calculated for every one of those tech firms last year, once it loads. There it is. So Apple's NOPAT last year, 97.5. I approximated 100 in our simple example, but that gets you the idea of the profit. That you're not NOPAT or NOPAT. Everybody with me? Custom formula number one. Okay? But we got to calculate operating ROIC, and that's just the numerator. Now we need what's called operating invested capital. So we go back to our custom formulas. The next custom formula you need is operating cash. So here's another nuance for next week. It doesn't need all 162 billion of cash to run the business, but it needs some of it. It's going to need some of its cash to make payroll, to pay suppliers, basically on a daily basis. The assumption we're going to use is 2% of revenue is operating cash. That's 1 week. All right. Any company needs at least 1 week of sales to run your business day to day, and you can't pay that out. The other 98% is excess cash that can be paid out. So we need to have, as we're doing working capital, we need 2% of revenue as operating cash. Custom formula number 2. Custom formula number 3, operating working capital. What are the current assets that are operating? What are the current assets that are non-operating? Okay, so we're going to do a formula for operating working capital equals operating cash. Custom formulas can also refer to other custom formulas that you have built. So my custom formula for working capital, operating working capital, is operating cash, which I just created, plus accounts and notes receivable, plus inventory, plus other current assets, minus accounts payable, minus other short-term liabilities. That gets me operating working capital. Then, to get operating invested capital, I take my operating working capital, add in property, plant, and equipment, add in the latest year's goodwill. Add those three together, operating invested capital. Then, next custom formula, operating ROIC equals the custom NOPAT divided by the custom operating invested capital, again, times 100. That's what you have to create in your account. Once you do that with these custom formulas, particularly operating ROIC is the important one, then you'll have operating ROIC. You can display it on your RV screen, which if we had done this before, I would have made you do this for your EIC assignment, because I think this is better representation of industry performance than the average ROIC, but that's not for Wednesday. Okay, it's for forward. But the other piece is you're going to do an EQS. EQS, as you know from your certification, is the equity screening tool, very powerful within Bloomberg, which means I can search the entire database of companies to filter out companies that meet any criteria that I want. So the screen that I want you to do is start out with companies in the S&P 500 index. So Bloomberg's got 1.7 million companies in its database, and I'm going to add criteria to limit it, SPX, limit it to the S&P 500 index. So that brings it down to 500 companies, which is actually 503 stocks. And if you're like, why are there 503 stocks in the S&P 500? And that's because Google/Alphabet is in there twice. They have Goog, G-O-O-G, and GOOGL as two stocks. So their two classes of stocks are part of the S&P 500. Meta, Facebook, has two classes of stocks. So those two companies, and I forgot who the third one is, have dual listed stocks. So even though it's one company, it's two stocks. Okay? So in the S&P 500, there's 3 companies with dual listed stocks. That's why there's 503 securities, but that's 500 companies. Okay? So this is the S&P 500. Then my next criteria in my screen is going to be to find, of the S&P 500, which of those companies have an operating ROIC, custom formula, greater than 20%. So then I'm going to add criteria, Op ROIC, condition greater than 20, which is actually 20%. So that will filter 500 companies to 145. So there's 145 companies last year that had an operating ROIC greater than 20% in the S&P 500. The next criteria that I'm going to use is a revenue growth rate year over year. So revenue growth year over year greater than 15% was the next criteria. And again, I want to do this based on the latest year, not the latest quarter. Hit enter, and that adds an and criteria. So there are now, when it loads, the 150 whatever companies have been 145 companies have been filtered down to 27. So there's 27 companies last year that were growing at more than 15% and had a 20% ROIC. And my final criteria for this assignment are then companies that have a bull beta greater than 2. So I come back here and I add the criteria of bull beta greater than 2, and that will take 27 companies, and that will further break it down to 3. So there's 3 companies in the S&P 500 that meet all those criteria. Okay? To see who those 3 companies are, you go down the bottom, you click on See Results, and those are the 3 companies. That is the first screenshot you have to turn in for homework 5. That's one point. Got to get to the screenshot. But you won't get to the screenshot if you don't get a correct operating ROIC. Questions? And in case you're curious, bull beta, what bull beta does versus traditional beta is it basically does a beta calculation on only up days. All right, so it takes historical up days, ignores the historical down days, and then does a regression. In fact, it's called a bear beta. It's the opposite. It ignores all the up days. It just takes all the historical down days of the market and says, what's the beta on just down days of the market? Okay? And the whole idea is, if we're in a bull market like we are right now, and the market's booming, I want to know when the market's booming what happens to my stock, bull beta, as opposed to traditional beta, which is what happens on any performance of the market. Okay? Same thing. In a bear market, bear beta is more indicative of what happens in a down day. So, again, trading term, but nonetheless, that's what I want you to do in your screening criteria. And this is what you're going to turn in. Questions? The other reason why I'm making you do this assignment, beyond the custom formulas, and this is a very important custom formula, and we're going to build more this semester, is I want you to think about the equity screening tool. This is a very, very powerful feature of Bloomberg, and if I'm doing a Bloomberg trading challenge, it can be very helpful. Because I can actually screen on anything. So again, I've referenced the trade war that's going on between the US and China. Okay? So if I want to know, and by the way, at the end, I can save my screen and it'll put it over here. So on the left, I can have my previously saved screens. Okay? So here's the point. Let's say I want to do a new criteria here for equity screening. What I'm going to do is I'm going to get rid of the bull beta. I'm going to get rid of the revenue growth rate. and I'm going to get rid of the operating ROIC, so I just have the S&P 500. And so for criteria, what I'm going to add is revenue. I can spell revenue right. Geographic segment revenue or geographic segment revenue percent. Show me companies in the S&P 500 that have 10% or more of their revenue coming from China. Show me companies in the S&P 500 that have more than 10 billion in revenue coming from China. I could do that screen. Show me companies in China that have a high percentage of revenue coming from the US. Okay? Because if two countries are fighting right now, those are the companies that are going to be most affected. So again, I can use this as I'm starting to read the headlines about the continuing trade war between the two countries to see which companies are most exposed. And so I could choose to trade off of that. So this is a very, very powerful tool. You can search on anything. Okay? And so again, I can do a product segment revenue. I'm reading about all the Tesla car crashes, electric vehicles. Who's got a high concentration of the automobile makers on electric vehicle sales right now? So again, I can go through and I can slice and dice. That's the equity screening tool. The one I want you to do is based on operating ROIC. That's the first half of homework 5. Questions? All right, second homework part of homework 5 is even easier. You're going to go to the company Eli Lilly. You're going to go to RV. BICS, make sure you do BICS. You're going to go to custom. You're going to load your spread template that you've done so far this semester. You're going to then, once the spread template is loaded, you're going to go to the gear icon, add a column. The column is called Operating ROIC, so that when you hit enter, you're going to have your traditional Bloomberg ROIC and you're going to have your operating ROIC. And you're going to save that and you're going to submit that. Okay, that's homework 5. But what you'll notice is that Lilly makes 15.5% on the average, but when it sells its drugs, it's making 34%. So again, like Apple, there's a big difference between the operating ROIC and the non-operating ROIC. When we look at a company like Merck or a company like Pfizer, right now, there's actually not that big a difference. And actually the operating ROIC is worse for both companies. Okay? So again, some companies are going to have a lot of non-operating items. Some companies are not going to have a lot of non-operating items. The ones that don't have non-operating items, pretty close to the operating ROIC and the average ROIC. The ones that have a lot of non-operating items, there could be a big difference. All right? And the same context I'll give you today is what I will tell you next week. You might be like, why? Why is this happening? Why aren't we talking about this? And it just goes back to why I'm old. So I took this class back in the 80s, right? And when I took this class at Wharton, the professor had just come from Chicago. So Chicago, which did all their work in the 70s, basically minted all the professors and textbooks, and I had some of the first edition textbooks at Wharton with some of the people in Chicago who wrote those textbooks had come to Wharton, and that they were teaching us how to do this stuff. And this is the time that Bloomberg started. And what I want you to know is, back then, it was a simpler world. There was no company in the world that had $160 billion worth of cash. Just nobody even thought to do that. They didn't have the joint ventures, where somebody would own a joint venture of another company that was worth more than they are, okay? And all these joint ventures that are now very valuable in the tech industry, it didn't exist. It wasn't a thing back in the 80s. So when they built the formulas, there weren't really a lot of non-operating assets. So they never had to worry about this. the whole idea of non-operating assets is something that's evolved over the last 40 years. And the world today is a lot different than it was in the 80s. And the problem is our textbooks have not changed. And the tools we use to calculate it haven't changed, and the formulas haven't changed. But the world changed. And that's what McKinsey recognizes. That's why McKinsey is like, look, we gotta recognize the reality of the companies we're dealing with today, and the textbooks that were written 40 years ago don't deal with this. So you can read your Brealey and Myers, or what do you guys even use? We had Brealey and Myers. Who's your textbook for finance? Who'd you use for 301? Who's your textbook? Did you use a textbook? Do you remember who your textbook was? We had Brealey and Myers and Russ and Westerfield were two of our textbooks. Did you have either one of those? Okay. I don't even know what you're using today. That's the point. Okay? But whatever you used, it all came back to Chicago and what they first did in the 70s that got regurgitated in the 80s and then spread out. But back then, it was a simpler time. And there just weren't a lot of non-operating assets, so nobody worried about it in the formulas. Now we have to worry about it. But whatever, it's what I want you to do. All right, that's homework 5. That's due Monday, 10 a.m. Your trading challenge needs to continue to be worked on. Your Netflix assignment presentation Wednesday. Homework 4, which is converting financial statements into this format, we're going to do for Wednesday of next week, and I'm going to talk to you about how to do that on Monday of next week. Question? You did what?
When adding the operating ROIC, did you do latest filing?
No, we're doing latest year for this one.
Latest year.
Latest year, not latest filing. And that will matter to getting a correct answer. All right, any other questions? All right, make sure you sign the sign-in sheet before you go. Otherwise, I'll see you guys on Wednesday. Look forward to hearing your presentations.